5 undervalued dividend stocks to buy now under $50. We're going to run through the historical performance of each company. We're going to look at their dividend safety, look at their financial metrics, and as always, we will run them through the valuation model, getting to the intrinsic value as well as our acceptable buy price, given that investor margin of safety, and we'll look to see what Wall Street are forecasting for these companies over the next 12 months. So let's jump into the first company. Now these all have some nice discount and some strong upside per Wall Street. The first one is Ligand and Platt, LEG. Now they are down over the last year, negative 39%. They are trading at their 52-week low with a very high yield touching 8%. And we can see a forward PE just under 17. Now, if you've been holding this company over the last 10 years, you would be down 24%, and we can see their all-time highs, May 21, of just under $58. So let's take a look. Now, the dividend says 50 score, borderline safe, market cap $3.1 billion. We're talking about a mid-cap company. Now, in terms of those recessionary metrics, well, they increased the dividend during the last recession. Below average growth, negative 25% versus the S&P's negative 12%, but they did in fact outperform the S&P, negative 44% versus that S&P's negative 55% recession return. Now, in my opinion, this is very positive to note. 4.5% increase May last year. Why I like this is because you are getting above inflationary increase. Remember, 4% is the minimum we want, whilst also getting a yield near 8%. The same for the last 5 years and over the last 20 years at 6%. In my opinion, very good when a company increases the dividend in line with inflation as well as getting a very high yield. They are also a dividend king. They have increased those dividends for the last 50 years or more. In terms of dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average, 7.92 versus 4.26. That is our first sign of undervaluation. Bearing in mind, we're not looking at any of these models in isolation. Forward PE 17.5. It does sit slightly higher than the average of 16.8. And we also note the consumer discretionary sector PE is lower at 14.7. Now, in terms of that free cash flow payout, regular viewers know we do ignore earnings data. It is susceptible to manipulation by management through accounting. Below 60% is my preference for free cash flow. Gives me faith management can offer those double-digit increases we love to see. 2022 at 69%. It isn't the greatest, but given how 2021 was extremely high, this is quite nice to see it has been lowered. 2023 at 52%, a nice positive sign in my opinion. Hopefully we will see some nice mid-digit increases to the dividend. Free cash flow per share, very inconsistent, 232 to 251 over the 10-year period. Nice to note in 2023 it is increasing to 348, so it is nice that there are increases from the prior year. Something to note, their top line is very inconsistent. As always on the channel for our deep dives, when we look at the revenue figures, we want to see steady moderate growth of 3 to 7%. 2021 very positive, 2022 pretty much flat, 2023 at negative 9% expected. It shows you the inconsistency with this top line in the company. So it has gone from 3.5 billion to 5.15. Again, do note they are expecting to drop their top line down to 4.8 billion. Now, this company has done share buybacks. It has also done dilution, so it has diluted your position effectively over the last 10 years. Overall, though, the net position, 147 million shares outstanding to 136 in the period, so they do ultimately return excess cash to your investor pockets. Now, when we take a look at the ROIC, return on invested capital, one of my 7 golden dividend metrics, what I like to see on this side is 10% as a minimum. It gives me faith that management are able to effectively allocate their capital. Now, it is pretty strong above that 10%. Just one thing to point out, it does look like it has been declining over the last 10 years, and we can see that with 9% expected in 2023. Just something I like to point out for investors to keep in mind in the future. Operating margin now very inconsistent. Unfortunately, it hasn't been able to maintain that minimum 12% and again has been decreasing. So we can see their margins are getting squeezed over time, notably with the 7% in 2023. So do keep this in mind when you're looking at your investment thesis and your forward guidance from the company. Free cash flow margin a little bit better, consistently above the 5% bar 2021. 2023 is looking nice at 10%, an increase from both the 2 prior years. Now, net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This shows us 1, the dividend safety, and 2, the balance sheet strength. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. We don't want this really to go above 3. 2023 expected 3.12, 2024 expected 3.3. Just something to be aware of, something to keep in mind when we are looking at their dividend safety, as if this continues to go higher, then the dividend may become questionable. Now let's jump into the valuation for LEG. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So typically on the channel, we do run through every single one of these models to get to the intrinsic value. Today's episode, let's jump straight in. So the intrinsic value for LEG is coming to $31. Now the current price at $23.46. We typically use a margin of safety, minimum 10%. Now this is if we believe the company has a wide moat, strong financial metrics, good forward-looking data. So we can see it has a 15% margin of safety. If we go to 20%, again, it's a 25% margin. At 25%, in fact, it is a few cents shy. So we believe for LEG, it has between 20 to 25% margin of safety. In terms of Wall Street and their outlook over the next 12 months, well, they see a price target of $26, upside of 11%. So bear in mind, right now, you are locking in a yield just under 8% with expected upside from Wall Street of around 11%. As always, as we go through these videos, do let me know your thoughts on these stocks, whether or not any of these are interested, or if in fact you have been buying any of these companies. The second stock that we are taking a look at today is Comcast Corporation, $45 currently. Hasn't had a bad last year, up just under 10%. Again, remember this doesn't include those dividends reinvested. They're also up 65% over the last 10 years, and we do note their all-time highs sitting in April 2021, or in fact August 2021 at $62. And they do have a yield of just under 3%, a forward PE of just under 11. In terms of dividend safety, a score of 89, very safe. Market cap 179 billion, a mega cap company. Now, key metrics, they increased the dividend during the last recession, above average growth at just under 4% plus, but they did have a near recession return, negative 52%. Dividend growth, in fact, they increased the dividend just last month, 6.9%, very nice, above inflation as well. Last 5 years, 9%, last 10 years, nice to see those double digits for this company, and they have been increasing those dividends for the last 15 years. So let's take a look at dividend yield theory, and we have that strong sign of undervaluation, 2.75 versus 2.17. Forward P as well below the 5-year average, 10.6 versus 13.7, so a double sign of undervaluation. And we also note the communications sector P is much higher at 18.5. Free cash flow payout then, I love seeing consistency, very, very strong, below 40% in fact. 2023, 37%, 2024 expected 38%, lots to love with Comcast. And when we look at their free cash flow per share, this is also what I like to see. It is increasing over the period. Now, it may not be very consistent, but we are seeing that growth over the longer horizon, and 2024 is expected to be more of the same at 326. Sales growth as well, very nice to see, 3 to 7% for the vast majority of the last 10 years. We do know, however, 2023, their top line was flat. So numerically, what this translates to is 69 billion to 122 billion. So they have pretty much nearly doubled their top line over the period. They also buy back a lot of their shares, in fact, more than 1 billion worth over the last 10 years, 5.24 billion to 4.15. So that is very, very strong and positive for those shareholders. ROIC for the large part of the last 10 years above 10%, and in fact from 2020 it has been increasing year on year, something I do quite like to see, and at a minimum that 10% is what we want to see from this metric. In terms of the margins, consistently very strong on the operating side, consistently very strong on the free cash flow margin side, so no real worries with this company, no red flag indicators to note just yet. Net debt to EBITDA, then we can see pretty much from 2020 it has been reducing, 2024 expected to go lower, so we can see why this dividend does look to be very safe, especially when we consider that low free cash flow payout around that 40%, so very positive for this company. It is, in my opinion, a high quality company. So let's take a look at the valuation for Comcast, and for today's episode, the intrinsic value is coming to $56. So with the current price of $45, we start off with that 10% margin of safety, and we see it is a buy. At 15%, it's still showing a buy, and at 20%, around 50 cents shy. So for Comcast, we do see around that essential 20% margin of safety. Now, in terms of Wall Street, they have a price target of $53, so they do still believe there is some strong upside with Comcast, up to 18% in fact. Moving on to stock number 3, we have another high yielder, EPD. Now we can see here the yield of 7.73%, forward PE at around 10, in the midpoint of the 52-week range, up 3% over the last year, and over the last 10 years, it is down around 20%. Again, it doesn't include those dividends reinvested, but something to bear in mind. Dividend safety, well, it is safe with that yield of just under 8%. Market cap, $58 billion, a large cap company. Recessionary metrics will increase the dividend during the last recession. Yes, they had below average growth, but they did outperform the S&P with a negative 37% return. They also gave an above inflation increase over the last full year. We love to see this with companies with very strong yields. Last 5 years, just under, which is unfortunate, but over the last 20 years, 5% on average is always strong to see. And they are 1 year away from becoming a dividend aristocrat, which is a very nice status for a dividend-paying company. In terms of dividend yield theory, very slight sign here of undervaluation, 7.73 versus 7.59. Likewise, the forward P to DCF ratio just under the 5-year average of 7.6. And we note it is pretty much in line with the sector P to DCF for energy companies. So let's take a look at the essential payout ratio. Now again, with LMPs, we don't look at the free cash flow payout. Unfortunately, they are a lot more volatile. So below 90% on the DCF for these MLPs. Now what we can see, it has in fact been decreasing year on year. 2022 at 54%, 2023 expected 57%, very strong. We can see so far why that dividend does look to be safe. DCF per share as well continues to increase year on year. Now yes, some years we do see some decreases, but over the longer period it is moving in the right direction. 2024 expected to be an increase from the prior year as well, is a positive sign for this company. Sales growth, important to note, it is very essentially cyclical, so we do note double-digit negative growth followed by double-digit positive growth. That isn't necessarily a red flag indicator, but always understand the type of companies you're investing in. What type of companies? Are they cyclical companies? Are they fast-growing companies? Or are they just mature companies? Now, we do see here numerically the numbers 48 billion to 50 billion in 2023. Now, this is very, very expected from LLPs. They do dilute your position over the longer term. So we can see it has gone from 1.9 billion to 2.19. Now, ROIC, nice to see. It is above that 10% over the more recent period. The last 2 years, 11% is strong. Does give me faith about management, especially when I use that as one of my criteria for investing in a company. Now, in terms of their operating margin, it is very, very inconsistent. Nonetheless, it is still above or around that 12% or more that we do look for companies. So nothing really to note here in terms of any red flag indicators. Now, what's very nice to see for MLPs, for the net debt to EBITDA, we do look for below 4.5. It has pretty much only crossed that once in 2016, and from that point, it has been decreasing. 2023 expected 3.07, 2024 2.93. So actually this could be one of those high yielding companies where the dividend based on this information isn't in question. So let's take a look at the evaluation. Now for today's episode, the intrinsic value is the average of these four, coming to $37. So let's take a look at the margin of safety at 10%. It is a buy up to $33. 15% still a buy, and we keep going. We can see even at a 20%, at 30% it isn't quite there just yet, so we see at least a 25% margin of safety for EPD. Now, what does Wall Street forecast? They sense upside of 20%. They do believe this is a strong buy with a price forecast target of $32. Do let me know. I know a lot of people love this company in the dividend community. Is this one you have been adding, or maybe one you have held for quite some time? We then move on to a real estate investment trust, VICI Properties. Now, this is trading around $30, down 12% over the last year. Over the last 5 years, we can see up 42%. Again, it doesn't include those dividends reinvested. The yield of 5.4% and a forward P to FFO of just under 13. Dividend safety, borderline safe at 50. Market cap, $32 billion. It is a large cap company. Key recessionary metrics, well, this company was founded after the recession, so there is no data available, and their latest increase at 6.4% in September 23 is very nice to see, well above that inflation of 4%, plus a nice starting yield, and they have been increasing those dividends for the last 4 years. In terms of dividend yield theory, we can see that strong sign of undervaluation, 5.43 versus 5.03. Forward P to AFFO, 13.7 below the 5-year average, so we do have that double sign of undervaluation. But we note the sector P to FO is pretty much in line with VICI's 13.7. Now, for REITs, it's very similar to MLPs. We don't look at the free cash flow, a lot more volatile. For hotel REITs, 75% thereabouts, which has pretty much been what VICI has offered year on year. 2023 and 2024 expected to be in line at 75%. Nice to note the adjusted funds from operation also increases year on year. 2023 and 2024 expected to be more of the same. Remember, they haven't just released their 2023 annual report yet. Sales growth, very nice to note, double digits for the majority of the last 10 years. And what we do want to see is that steady moderate growth of 5 to 10% when we look at REITs. For other companies, remember 3 to 7. Adjusted funds from operations per share is also very important, in fact more important for REITs than the sales. And we see nearly double digit increases year on year. 2023 expected 15%, very nice to see. 2024 at 5%, also not too bad either. Shares outstanding, as we always mention for REITs, very, very typical. They do retain a little of that internally generated cash flow after paying dividends, so they do need to essentially dilute your position over the longer term to increase their capital. So again, just bear in mind, different REITs will dilute your position, different rate over time. ROIC for REITs, 3 to 5%, nice to see for VICI. 5% pretty much seems to be the bottom over the last 6 years. 2023 at 8%, it does make me like this company a lot. And full disclosure, this is one that I do hold. Operating margin also very nice, a little bit inconsistent, but we do see the 90s at least over 3 years of the period, so that is always positive. And when we look at the net debt to EBITDA, this is probably one of the reasons why we see that borderline safe score on the dividend. We want to see below 3.5 for hotel REITs. Now, yes, 2022 was very high at 6.46, 6.02 expected in 2023, 2024 expected to go lower, so they are moving in the right direction, which is always a very positive sign. So let's get to the valuation for VICI Properties, and as always, don't forget you can click on the pinned comment below if you want to grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio or that on your watch list. So we keep going, and we can see that VICI Properties has around a 20% margin of safety at $30. So right now we believe it to be around 15 to 20%. In terms of Wall Street and what they forecast, well, they see upside of 18% with a price target of $36.13. Let me know in the comments if this is one of your favorite REITs, or if there are other REITs out there right now that you believe to be more undervalued or have a lot more upside. We then move on to the final stock, which is Kroger Company. Now, over the last year, they are up just around 3%. Over the last 10 years, up 155%. Bear in mind, their all-time highs we see at around $62 in April 2022. The yield sits around 2.51%, forward PE at around 10. And when we take a look at their dividend safety score, 71, it is safe. Market cap, 33 billion, it is a large cap company. Now, in terms of those recessionary metrics, they increased the dividend during the last recession, above average growth, and also outperformed the S&P, negative 31%. Dividend growth, this is why dividend growth investors love Kroger. 12% last summer, 15% over the last 5 years, 14% over the last 10 years. Double digits, we love to see that. And they have been increasing those dividends for the last 16 years. In terms of dividend yield theory, again, another sign of undervaluation on both the yield and the forward PE, 2.51 versus 2.18, 10.4 versus 12, and we do note it is much lower than the consumer staples of 19.8. So let's take a look at that free cash flow payout. Now, it is very inconsistent, but we can look at the more recent period. 50% in 2023, 2024 expected 31%, so that is very positive to note, especially why we can understand that they are offering those double-digit increases year on year. Free cash flow per share is again very inconsistent, 121 in 2014, 198 in 2023, but we do note 378 expected in 2024, so they do grow over the longer term, but be aware those year to years you may face some drops that you should be expecting. Sales growth 3 to 7%, it does look like it pretty much hits that year on year. The last few years looking very strong, between 4 to 8%, and we note their top line has gone from 98 billion to 148. Also, I love to see this from companies. They do strong, consistent share buybacks. They have reduced their share counts by essentially 315 million shares. Very positive to note. We do like this. They are essentially returning a lot of excess cash to the investors. ROIC, very nice as well. This is a very strong company. 10% or more consistently. 14% in 2023. Lots to love here. What's not to love? Well, very clear to see that operating margins, which the companies in this industry do suffer from, 2 to 3% is pretty appalling in my opinion. However, it seems to be the norm for this company. Just bear in mind that investors, that if consumers do start to get squeezed and do want to buy cheaper products, then either Kroger will lose a lot of customers or they will have to drop down these margins even lower, which will affect their bottom line. And we can see the free cash flow margin again struggling. So these are two metrics I would keep an eye on if I was an investor or potential investor. Net debt to EBITDA, no real worries here. They have been decreasing it ever since it peaked in 2019. 2.12 expected in 2024, 2.22 in 2023. So it is nice to note this is a company that does have a very strong hold on their balance sheet, and the dividend does look to be safe for now. Now, before we just jump into the valuation of Kroger, just to let you know that we do send out free weekly newsletters. Now, the latest episode, we do an article on yield on cost. We talk about size, whether or not it really matters. We've also run through undervalued companies. We've taken a look at some of our metrics for screening undervalued companies. If you want to take a look, click on the pinned comment below, completely free as well. So let's take a look at the valuation of Kroger. And as always, if you have enjoyed the episode, value has been provided. Smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list by clicking on the pinned comment below. So margin of safety at 10%, we can see it is pretty much trading a few cents around that level. So with Kroger, it is a very high quality company as we ran through the metrics, although there are some just to be aware of. We see around a 10% margin of safety. In terms of Wall Street, well, they have a price target of $53.30, around 16% upside over the next 12-month period. As always, let me know your thoughts in the comments below. Have you been adding any of these 5 companies which looked undervalued and under $50, or any of these that you may be adding onto your watch list? As always, have a great day. Catch you all on the next episode and take care for now.